The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem.
Yeah, as Christine was saying just before, it is Fed Day, and everyone's expecting a 25 basis point increase in the Fed funds rate. So joining us now to discuss is Ben Emons. He's Managing Director of Global Macro Strategy at Medley Global Advisors. Good morning, Ben. How are you?
Good morning, Lawrence. Good to see you, and thanks for having us.
Of course. Thanks for coming on. So let's get right to it. The yield curve, it's flattening in the bond market, right? The treasuries are all flattening in yields. That's usually a warning sign for recession. At the same time, we're looking at inflation now at about 7.5%. So did the Fed take too long to raise rates?
On that basis, you could say yes, because the market is really pricing in that the Fed would have to go, we say, restrictive, right? It would move rates up to what they say is a neutral rate, and it sounds a bit technical, but if you think about it, like, you have to bring rates up to such level that you can then really affect inflation, but you would also affect the economy, and that's what the markets are being jittery about. And the recent volatility in equities had a lot to do with that. It was not just the Ukraine story and the impact that has on inflation, but really then market taking that to, well, inflation gets too high, the Fed has to move faster, and it hasn't done anything just yet. So this is a long-awaited lift off in rates. And now the question is how much they're going to go from here, how fast, and that's what everybody will be watching today.
Yeah, I mean, right now we're expecting how many rate hikes? Like 9? When do we start seeing the full effect of these rate hikes to really kick in?
Well, there's a few ways to think about that. So yes, it's indeed about 9 hikes. That's by the middle of to late next year priced in. And you would want to see that through 3 channels. One is through the dollar, right, that has been strengthening since the middle of last year, but not really to such extent that is what we call a surge in the dollar. If that were to happen, then that could meaningfully impact the second channel, which is the commodity markets, which, as we now know, are haywired because of the Ukraine conflict. The stronger dollar will affect commodity prices to the downside. And then lastly, of course, it's through what we say financial conditions, which is a broad term for equity, bond markets, and credit markets. Those financial conditions would then tighten as the Fed raises rates. That too has happened, but not so significantly as we've seen in previous crisis episodes. So there's still some way to go here before we can truly see the impact from these rate hikes coming through. But that will happen is likely, especially if they signal today that they're willing to take Fed rate hikes really further out and into the future.
And do you have a sense of how this will all impact the crypto markets? We've been seeing a lot of volatility.
Yeah, it will certainly impact that market too. Some people have likened it to that the Fed liquidity is directly related to what's going on in crypto. That may be true. I think it's also to do with that the correlation of crypto and the equity market has picked up significantly since last year because more and more companies are using crypto as a service or as an asset on their balance sheet. So therefore, that correlation is there. So you could say that, yes, if the Fed raises rates and tightens those financial conditions, which includes lower equity prices, then it will affect crypto as well. I think that's the way to think about it.
So, welcome to the show. But just in terms of affecting crypto, so the crypto world has been, and the larger financial world in general, has been talking about these rate hikes kind of forever, right? I mean, they've been anticipated for a long time. And we've already seen headlines of the crypto markets reacting to these anticipated rate hikes. So the question is we know that we assume that there's some sort of impact, but has that impact already happened? To what degree is it already priced in? And to what degree do you think that the market could react anew to whatever happens?
I think it's a fair point to say that there has been an anticipation that has led to a pricing in of the effect of rate hikes. So if you really think about when Bitcoin hit sort of a $65,000 about high, and we went all the way down below 30,000, that does show that there's that sort of path price in of what the first, let's say, part of the rate hike cycle would mean for asset prices. Same thing with the S&P, corrected about 12% from the high in November of last year. So there is some pricing in, but not entirely, and that has to do much with the economy. We have slowed down, but we're by far not in any kind of recession scenario. We have a lot of inflation. Inflation will likely go higher, and that's, I think, what the market will look at next. Like, if we're going to see more higher prints in inflation, the Fed will have to follow through with these rate hikes quicker. And that, I think, is not priced in, even though the number of rate hikes looks like a lot, like 9, but the pace of rate hikes is still much slower. There will be just a few hikes priced in by next year. Will that change as the Fed signals like we're ready to do this faster? I think that's not priced in.
So could one of the methods by which you could go faster, of course, it's sitting on $9 trillion in debt, in assets rather, that it has on its balance sheet, our U.S. debt. So is it possible they might flood the market or at least add some or sell back the assets on its balance sheet if it needed to accelerate the rate hikes as another tool in its war chest? Or are they going to just hold on to that $9 trillion for forever?
I think it's a really important point, Lawrence, because if you look at the balance sheet from the Fed today, it's indeed $9 trillion. It holds about $4.5 trillion of treasuries and something about $3 to $4 trillion of mortgage-backed securities. But then on top of it is what they call reverse repos, which is something like $1.5 trillion. That's the first part of the balance sheet they may look to take down, because that's nothing else than just simply a collateralized transaction with money market funds and other entities. They take that liquidity down and then bring down the side of the asset side as well. I think that's been communicated by the Fed several times now, about $1.5 trillion or so that they're looking to reduce the balance sheet by. But that actually isn't really bringing the balance sheet to a level where monetary policy is tightening further, because those reverse repos are as I said, just collateralized transaction. It really comes down to if the reserves in the system that the Fed has created are going to be reduced. In 2018, they had that effect on markets when that was happening, and that will still, I think, take some time before that comes through. So look for the balance sheet to be reduced by $1.5 trillion or so, but mostly by those reverse repos at first, before the reserves will be shrunk.
So what do you expect today that the rest of the market isn't expecting, or do you think that the market is pretty much on target here?
Yeah, the market's on target, and I'm smiling actually because, it's an interesting point too that, what's now really not expected here. Everybody knows that they're going to lift off. People will look at the projections for GDP and inflation and the dot plot, as they call it, the trajectory for interest rates. The expectation is that the Fed will move all of that up and will move inflation projections up. So what could be the surprise there? Yeah, the Fed shows a more aggressive rate hike path in the future, shows that it's much more concerned about rising inflation than what's been communicated before. I think those are elements of surprise, as well as that the willingness to go faster with rate hikes in the future by overemphasizing that, not just 50 basis point rate hike, but just simply taking quicker steps to get back to the so-called neutral rate. That will be scrutinized by markets, and that could surprise markets if there's language from Powell come that way. And we know how he can be communicating. He can be very pragmatic, so we do have to be ready that he may surprise markets.